Hi and welcome to our tutorial on dollar cost averaging. In a world of private investing, there's an exhausting obsession with perfection. We're told we need the perfect stock, the perfect macro outlook, and above all, the perfect entry point. So today we're going to be debunking the myth of the perfect entry. We're going to explore the strategy that trades the anxiety of timing the market for the cold, predictable science of consistency. It's called dollar cost averaging, or DCA, and over the next few minutes we will look at the mathematical truth behind this strategy, examine a real-world 10-year case study, and discuss how automating your execution can systematically eliminate the worst enemy of your portfolio, which is, of course, your own emotions. So let's start with the harsh truth that every private investor must confront. Market timing is a statistical losing game. Every institutional fund manager with supercomputers and armies of analysts routinely fail to catch absolute market bottoms or sell at absolute peaks. So for a private investor, attempting to time the market introduces several vulnerabilities. If you have a lump sum of capital and you want to deploy it all at once, you're exposed to what we call sequence of returns risk. If the market drops 20% the following month, your capital is instantly impaired, and it could take years just to work back to break even. The core philosophy of dollar cost averaging is simple. We accept that we cannot predict short-term price movements, so we shift our focus entirely to maximizing our time in the market rather than guessing the timing of the market. So what exactly is dollar cost averaging? Well, it's a framework driven by three distinct structural elements. First, it operates a fixed schedule, so you commit to investing a set amount of money at regular intervals. So for example, €500 on the first day of every single month. Second, it relies on volatility smoothing. Because your investment amount is fixed, the math works in your favor. When prices are high, your fixed sum buys fewer shares, and when prices plunge, the exact same sum automatically buys more shares. And third, it's automated. It turns wealth accumulation into a system, and it removes the need for you to look at daily stock charts, read financial news, or experience the mental paralysis of wondering whether today is a good day to buy. You let the system do the work for you. So to see a strategy in action, let's look at a realistic historical model. Imagine an investor who committed €500 every single month to the S&P 500 index over a 10-year horizon, stretching from January 2015 to January 2025. During this specific decade, the market was anything but smooth. As investors sat through the global growth slowdown in 2015, a sharp market correction in late 2018, and the unprecedented flash crash of the 2020 pandemic, and a grueling bear market in 2022. Now look at the results. Over those 120 months, the investor quietly contributed a total principal of €60,000, and because they didn't stop during the crashes, their final portfolio value in early 2025 stood at €124,719. This is the net gain of nearly €65,000, representing a total return on capital of 107.8%. So let's look a little deeper into this example and see the exact maths that generated that outperformance. The table highlights three critical market events from our decade-long timeline. In January 2022, the market was at a cyclical peak. The S&P 500 price was high, hovering around 4,750. The investor's regular €500 deposit went to work, but because the price was steep, it only acquired 0.1053 shares. Just 12 months later, in January 2023, the market was in a painful bear market, dropping to 3,850, and headlines were plagued with economic gloom. A typical investor would have paused their contributions out of fear, but our dollar cost averaging investor stayed automated. Because the price was lower, their €500 automatically bought 1.299 shares. They bought more shares when the market was on sale. When the massive bull market recovered, a recovery arrived in January 2025, pushing the index to 6,000. Those extra shares accumulated at a discount acted as a premium fuel for their portfolio's final explosion in value. So we can see that the maths of the dollar cost averaging system is very elegant, but it's the psychological value that is even greater. And as human beings, we're hardwired with behavioral biases that destroy financial returns. We suffer from FOMO, the fear of missing out, which drives us to buy heavily at market peaks when everyone else is celebrating. And conversely, we suffer from loss aversion, which causes us to panic and sell or freeze up during market corrections. Dollar cost averaging acts as a psychological circuit breaker. It bypasses your emotional brain entirely, and when the market drops, instead of panicking, the dollar cost average investor reframes the event with my €500 is simply buying more units this month. It eliminates regret bias. So you no longer have to look back and say, I wish I waited to buy. The schedule dictates execution, removing human frailty from the equation. So now let's have just a quick summary of the advantages that this system brings. First, it guarantees a lower cost basis over long horizons. By naturally buying more volume at low prices and less volume at high prices, your average cost per share is mathematically optimized. Second, it builds an ironclad discipline. It forces you to treat investing not as an afterthought or a hobby, but as a non-negotiable monthly expense, just like a mortgage or paying a utility bill. You pay your future self first. Third, it ensures market entry readiness. Many investors miss the first week of a market rebound because they are waiting for certainty. But history shows the sharpest gains happen right at the turn of the cycle. With dollar cost averaging, you are guaranteed to be at the table when those explosive green days happen. Now, for comparison purposes, let's look at the alternative out there. And that alternative is called lump sum investing. So if you inherit a large sum of money or sell a business today, should you invest it all at once or space it out via dollar cost averaging? Mathematically, if the market goes straight up in a vertical line, a lump sum will outperform dollar cost averaging because you deploy all your cash at the lowest available initial price. However, we live in a real world and real markets fluctuate, so lump sum investing carries a massive psychological burden. If we deploy €100,000 all at once and the market drops 15% the next week, the emotional trauma often causes private investors to panic and sell at a loss. Dollar cost averaging is a superior framework for risk management and behavioral survival. It guides your peace of mind by averaging your risk across time. A critical warning must be given regarding where you apply this strategy. Dollar cost averaging is not a magical cure for bad assets. If you apply dollar cost averaging to failing individual companies whose stock is on a permanent slide to zero, you're simply throwing good money after bad. So dollar cost averaging is safest and most effective when paired with diversified broad market instruments like the S&P 500 index or global equity ETFs. And when you invest in a broad index, you're betting on the long-term ingenuity of growth of human commerce. While an individual company can go bankrupt, a diversified basket of the world's top 500 companies would historically recover and grow over multi-year cycles, making it a perfect vehicle for consistent automated accumulation. Many private investors believe that by keeping their money in cash and waiting on the sidelines, they're choosing a safe option. In reality, sitting on the sidelines exposes you to the invisible punishing inaction tax. Look back at our case study. The investor who systematically deposited their money built an asset worth over €124,000, pocketing nearly €65,000 in net gains. The individual who held cash out for fear over those same 10 years watched their purchasing power get eroded by inflation. The biggest risk in modern investing is not market volatility, it's the opportunity cost of missing out on the compounding cycles that drive global wealth. To anchor this mindset, consider the perspective of the world's most successful practitioner of long-term investing, Warren Buffett. He once remarked, "When we bought anything, we always hoped it would go down for a while so we could buy more." This is the ultimate evolution of an investor mindset. When you shop for clothes, groceries or anything, you're delighted with the latest sale and to bag a bargain. Yet in the stock market, when a sale happens, most people run out of the shop in a panic. Dollar cost averaging naturally aligns your behaviour with Warren Buffett's philosophy. It trains you to welcome market dips as premium buying opportunities. In conclusion, wealth is not built by a single heroic flash of brilliance or perfect market timing. It is accumulated through the unrelenting power of consistency. By adopting a dollar cost averaging framework, you remove the guesswork, neutralize your emotions, and build a systematic bridge to your long-term financial independence.